market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Joanna Versace in Dubai, filling in for Francine Lacqua today. Now, the delayed U.S. jobs report for January is expected to show a notable markdown to payrolls growth. Traders will turn their attention to what that might mean for rates. The Fed's Beth Hammack believes they will be on hold while the data is assessed.
Rather than trying to fine-tune the funds rate, I'd prefer to err on the side of patience as we assess the impact of recent rate reductions and monitor how the economy performs. Based on my forecast, we could be on hold for quite some time.
With me now is Ven Ram, Bloomberg Markets Live cross-asset strategist. Big data coming up today. We have the jobs print. The headline number is expected to be a 65,000 rise. How much is this going to move the needle, do you think, for Fed and Fed policy in the second half of this year? We just heard from Beth Hammack saying she expects rates to be on hold for a while.
I think that if the number is anywhere along the expected lines, I think the Fed will take it as read. I think that the more important read will be the jobless rate number. For a long time, we never saw a jobless rate above 4% in this expansion, Jumana. So we are getting consistently readings above 4%, now 4.4%. So if that picks up, I think that will have the Fed worried, because we are in this lower higher, low fire environment, and if anything challenges that assumption, the Fed will be a bit concerned. But, you know, to go back to Beth Hammack's point, I think the Fed is well poised at this point, because if you look at their inflation forecast and if you look at their forecast for economic growth, the Taylor rule posits that the rate should be exactly where they are.
Right.
So I think that, you know, that's why she's saying what she's saying.
Interesting. But yesterday we did have weaker than expected retail sales figures. And on the back of that, you did see bonds rally. You saw 10-year yields at the lowest level, actually, in the past month. What is that having a notable impact on the USD? Is this sort of the second leg of the dollar underperformance for this year, you think, the catalyst for the market pricing and more easing?
Absolutely. I just did an analysis this morning, which is available for terminal subscribers. It shows that the dollar is undervalued by 4.2%. That's a huge undervaluation gap. And that kind of goes back to the April tariffs last year, when the gap was similar. So I think that, you know, this is bringing on dollar hedges. People are concerned that, you know, the Trump maybe wants a weaker dollar. We heard him say that last month. And, you know, also the rate checks on USD JPY, which they've walked back, I think those have done immense damage to the dollar. So I think that the dollar is going to remain on the back foot for now. Yeah,
and a lot of whiplash in that dollar-yen currency pair. Ven, really good to chat to you. Bloomberg MLive strategist Ven Ram. Well, to continue that conversation, we're now joined by Nannette Hechler-Fayd'Herbe, EMEA CIO at Lombard Odier. So much to talk to you about, because we've got macro, we've also got micro. We've had a bunch of earnings hit, and of course the AI disruption of last week. Let me just start with the macro this week. How important for market direction do you think today's jobs figure is actually going to be?
I think it's going to be quite relevant for especially fixed income markets and expectations of future Federal Reserve policy, especially if layoffs are picking up. This is certainly the area of focus right now. The macro data will, I think, give new information for Fed policy in the second half of the year.
Does the appointment, or I should say the nomination of Kevin Warsh, substantially have an impact on what you're expecting out of monetary policy for the second half of this year?
I have always had the view that the debate around the person of the next chairman or chairwoman of the Federal Reserve was much too focused on personalities. I do think that the composition of the board is much more important. Monetary policy is being set in consensus in the governing board, and so for me it's much more important to see how that board is continuing to get composed of for the future.
Okay, fair point. Let's talk about markets, the price action between last week and this week. You saw in the middle of last week a real shakeout in some of the AI ecosystem. Software as a service took the major brunt of the selling. By the end of the week, you saw a massive short squeeze take place. Do you believe that the worst of the selling is behind us now?
We have certainly regarded this as an opportunity for investors to take exposure to a sector that commands generally a premium over the broader IT sector. I'm referring to software. There has been a lot of concerns that AI might be disrupting software companies, but we have held the view that actually it is empowering them. It is shortening the time for coding. It is enabling efficiencies of workflows. So for us, it's actually been an opportunity here to take exposure on a sector that gives also possibilities to invest more on the cloud infrastructure and also on some subsectors like cyber defense.
Yeah, I mean, last week there was also a lot of talk about this pullback incentivizing a rally elsewhere, i.e. that it would be an opportunity for us to see a more broadening of the rally that's taking place in U.S. stock markets. Do you subscribe to that view as well? And if so, which other parts of the economy do you want to have exposure to?
You know, certainly the tech sector continues to have strong earnings drivers, and we should not be looking away from that when opportunities such as those on software arise. But you're right to say that macro data have been actually better than expected altogether in 2025. We have upgraded our outlook for 2026 in terms of global growth, and that bodes well for a number of sectors as well, regions that benefit from better growth. Materials is one sector that we really like. We think that there is still a lot of upside. With your previous guest, you've also discussed about what commodities are doing. Metals are playing a very important role. So material sector, one that we like, and healthcare, I think, as well, for different reasons. Altogether, it does speak for a broadening of the earnings trend, positive earnings trend for more sectors.
Yeah. Well, let's talk more about the geographic divergence with earnings, because what you got is a pretty robust earnings season so far out of the U.S., but in Europe, it's a mixed bag. And one thing that caught my attention this morning, a Citi index showing that more analysts have downgraded rather than upgraded profit estimates since the end of 2025. How does that set the stage for the European equities outlook for this year?
I think European equities have, over the past 2 years, really depended on only a few sectors, financials being one very important one in Europe. So how the broader market in Europe develops over the next months very much has to do with how financials are doing. And also, of course, industrials for different reasons. So in Europe, I would expect a continued mixed bag. We have the region at neutral, but there have been some positive surprises in Asian regions, Japan in particular, obviously standing out, and with the political clarity that we now have with regard to economic policy in Japan, I think a good omen for continued earnings trends going up.
Well, I was going to ask you whether you think this trend, the momentum behind Asian equities outperformance, can continue in the near term. You point to, obviously, the price action in Japan, the Nikkei touching an all-time record high. But do you think that this rally still has legs?
There is always possibility for volatility. We should not forget that earnings are very dependent also on where the yen is headed. Should the yen strengthen, there might be a little bit of momentum stalling, but many investors do take exposure to equities in Japan, perhaps unhedged, and so they could gain at the margin on their currency position what they may lose in earnings strength. So I'm not so worried with respect to the outlook for Japan. And for broader Asia, I think there is a number of factors that are speaking for even Asian emerging markets. And we hold a positive view altogether for emerging markets, think that they have good exposure to some of these critical commodities that are likely to see a comeback altogether in 2026.
Okay, so I understand the commodities angle. One thing that we didn't discuss that perhaps is quite integral to the performance of emerging markets is the weakness in the USD. Do you expect that to persist and therefore to provide somewhat of a tailwind also to some of these emerging market assets?
I think that's the case because in the U.S. we are likely to see rate cuts later in the year. That provides for a cyclical environment that is translating into a little bit more weakness of the dollar. Importantly, we should distinguish that cyclical weakness does not mean a debasement. So I've always made that point. We are not talking about a dollar debasement, but of a cyclically weaker dollar. 122 in euro dollar over 12 months is about where we are seeing this currency pair. In that context, emerging market assets altogether, whether it's on equities or also on bonds, are going to do well.
Nannette, a real pleasure to chat to you. Thank you so much for coming on the Pulse today. Nannette Hechler-Fayd'Herbe, EMEA CIO at Lombard Odier. Now, coming up, the head of the European Council tells Bloomberg there's a new urgency for the EU to finally unify its markets. Details next. This is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Where's the emphasis, on headline payrolls or on the unemployment rate?
I'm focused on the unemployment rate, as is the market.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
What we're seeing is certainly a growing labor force.
A labor market that actually could be improving.
The January jobs report, today on Bloomberg.
Welcome back to The Pulse. Well, Bitcoin has drawn fresh support from its largest holders. So-called whale wallets accumulated about 53,000 coins in the past week, their biggest buying spree since November. For more, we're joined by our senior editor for digital currencies, Ana Herrera. So really interesting to see this price action, well, I should say the buying emerge in the context of the price action. How much of this is about signaling a bottom versus pure damage control, given how much the price of Bitcoin has dropped?
I mean, that's a very interesting question. It's hard to know. Obviously, the whales, I guess, have an incentive to make sure that we don't fall further. It could also mean that they do think this is a sort of good buying opportunity. Historically, Bitcoin has tended to go up again. What's very interesting, though, is that, obviously, the price, we haven't seen a lot of new buyers come in. And that's a signal that things aren't going to go very well, perhaps, for a while longer. Bitcoin, historically, when the price has gone up, has drawn in a lot of retail investors. And that's not really happening yet. And we can see it in the ETFs as well.
Well, this is the thing, right? So there was a lot of hope that you'd get a broadening of the buyer base of Bitcoin, institutional buyers, retail buyers, the launch of those ETFs. But actually, if you look at the ETFs, they've been net sellers over the past year. So about $11 billion in sales in aggregate. Is that likely to continue?
I mean, I guess it depends on sentiment and how the price goes. Today, for example, we are seeing Bitcoin fall again. It doesn't seem like it's tracking Asian equities either, which was what it was doing for a while, going up with equities, especially or down with tech stocks. So it's hard to say. Obviously, Bitcoin ETFs have been and crypto ETFs have been a big success from the beginning. So maybe that's just a little bit of repositioning from that large inflow. But obviously, one of the things that the market is struggling with is that it doesn't seem to have a new narrative, right? Historically, we've seen Bitcoin compared to digital gold, Bitcoin compared, to a hedge against inflation. And now it seems like it's falling in between and people aren't really sure what it is. So until it finds a new sort of narrative, it might be hard to see how it goes up significantly and therefore the ETFs attract more flow.
Yeah, or maybe just a turbocharged risky asset. Ana Herrera, thank you so much, our senior editor for digital currencies. Thank you. Well, Commerzbank lifted its guidance for profit this year after reporting higher than expected earnings in the fourth quarter. It's a boost to CEO Bettina Orlep as she continues to defend the bank against a potential takeover. She spoke to Lizzie Burden on Bloomberg Daybreak Europe.
This is the best result we ever had in the history of the bank, 18% plus in comparison to 2024. And it was mainly driven by three topics, not surprising ones: growth on the revenue side, very good cost discipline, and high asset quality. And that then leads also to a very attractive capital return of 2.7 billion euros in total, which we return to our shareholders for 2025, including a very attractive dividend of €1.10, which is 70% up in comparison to 2024 dividend. And actually, the story continues because I have the benefit of already looking on the January number, and we had a very strong January.
And you've also lifted your guidance for profit this year. What are the main risks to that outlook?
Well, I mean, first of all, we concentrate on the tailwinds, and what we see is that we will see for the first time after 3 years, we expect growth for German GDP, so it's 0.9%, which is clearly helpful. We also assume that there will be, at least for Germany, a stable, or Europe, a stable interest rate environment, which is also supporting our case. This is also why we raised our outlook for NII to 8.5 billion euros. Then we strongly believe in our power to increase our net commission income by, again, 7%, and then combined with strong loan growth and a good cost discipline, that leads us to the raised outlook, with also a much improved cost-income ratio of 54%.
Bettina, can you put a number on how much that German fiscal stimulus is going to boost Commerzbank this year? Because the Deutsche CFO was a little more hesitant. They think that it's going to take a bit longer to really feel the impact on their bank.
Well, I can only look on the 2025 numbers, where we basically have not seen any growth for Germany, and still we reported a loan growth of 10%. So we are kind of not completely independent, for sure, but we're kind of independent. But because what we do is, specifically when it comes to investments of our corporate clients, we are at their side wherever they go. So either they invest in Germany or they invest abroad, which we have seen in 2025, and we are part of it. But clearly, the 0.9% will also help our growth.
That was the Commerzbank CEO Bettina Orlopp speaking to Lizzie Burden earlier. Now, EU leaders are set to meet tomorrow to discuss ways of integrating their markets. The president of the European Council has told Bloomberg that the bloc needs to unify its markets if it wants to compete globally. Let's bring in Bloomberg's chief Europe correspondent, Oliver Krook. Okay, Ollie, so there's this big EU competitiveness summit taking place tomorrow. And the single market once again on the agenda. What do we know about what they're looking to achieve?
Yeah, I mean, I think even so, how difficult to pronounce and often spell the word competitiveness speaks to some of the difficulties of getting that competitiveness up at the European level. Because at the end of the day, we've been talking about this for about 18 months, Jumana. We've had the Draghi report. He spoke in very stark terms when he put it out last September. And we should say that we haven't made a huge amount of progress in terms of actually achieving a lot of the concrete steps he laid out. He basically said Europe has two choices. Either you make very significant, somewhat painful reforms, or basically the European economy just limps into the sunset and basically becomes irrelevant. And we have seen the European economy sort of diminish globally in terms of its importance. So for Antonio Costa, the head of the EU Council, whose job it is to really bring all of these 27 leaders together for collective action, his priority this year is all about that competitiveness. It's about cutting red tape across Europe. It's about sort of cutting back regulations. It's about sort of getting that capital markets union that we've talked about for 10 years over the line. And that is going to be one of the major discussions. Now we have Emmanuel Macron referring to this moment for Europe as the sort of Greenland moment, this moment where it sort of moves together collectively in the sort of face of that very difficult Trump administration. But also we were talking to him about this idea that Mark Carney has presented, this idea that this multilateral order can actually be upheld by the middle powers. So I asked Antonio Costa whose job it is to basically align 27 middle powers out of this sort of theory of that really sort of beautiful idea laid out for Mark Carney. What does that look like practically? Have a listen.
I'm not so pessimistic as Mark Carney has been, and I don't said that the rules-based order is died, and we need a new one. Of course, is under threat, but I think we are strong enough to protect the rules-based order. because we don't have a real alternative to the rules-based order. The alternative is the chaos. And that's why like-minded partners like the European Union, United Kingdom, Canada, Japan, and other countries are very strong upholding the international rules-based order. One of the reasons, because we are investing a lot in these trade agreements, is because we need a rules trade order to ensure predictability to the economic agents. It's impossible to have a strong economic growth with uncertainty. And we need to provide certainty. And the best way to provide certainty is to protect this international rules-based order also in trade.
So in many regards, this meeting of European leaders that begins tomorrow is not just about sort of what they want to achieve in that meeting, but really what the entire year is going to look like. And really, it's going to be that word, competitiveness. Let's see if it doesn't get sort of blown off course from Washington, D.C. and what we get from the Trump administration in the next few months.
And also, if I can eventually learn how to say it, Ali, look, while we have you, I also want to ask you about the EU-US trade deal. Around Greenland, there were questions about whether the EU would actually push forward with those discussions. What is the latest now?
Yeah, so basically after that Greenland detour, this was supposed to be ratified earlier in the year. It was delayed because how can you sign a trade deal with a partner who's basically threatening to impose further tariffs? It has now gotten to the point where the European Parliament will sign this into law. However, they've added a few clauses in it, basically clauses covering that if there is any sort of threat to territorial boundaries, the trade deal can be renegotiated. If you do not get a deal on steel and aluminum, and remember, this is still the big thing that's outstanding for European leaders, there are still 50% tariffs on steel and aluminum. If you don't get a breakthrough from that, the EU is still reserving the right to basically renegotiate the deal. But for the time being, a sort of story that began in April with Liberation Day, a deal that was really agreed to in July at Turnberry, and now it is going to be signed into law likely at the end of this month, really moving the conversation forward on trade and hopefully for the last time from the European perspective. But of course, Jumana, there's no guarantee of that.
Yeah, there never is. Ali, good to chat to you. Oliver Kirk, Bloomberg's chief Europe correspondent. Well, coming up, we're going to turn to commodities. Oil is gaining on concerns over Iran, while Indonesia moves to shore up nickel prices. We'll talk all things commodities next with Francisco Blanch from Bank of America. That's coming up next. This is Bloomberg. Good morning and welcome to The Pulse. I'm Joanna Bersetchi in Dubai. These are your top stories. Weak U.S. retail sales bolster the case for further Fed easing. Traders now turn their attention to the delayed January jobs report. The world's biggest nickel mine is ordered to drastically cut output as Indonesia seeks to revive prices of its biggest export commodity. Plus, Siemens Energy jumps as surging demand for electricity pushes orders for its gas turbines to a record. But at least 10 people have been killed and 25 injured in a mass shooting in northern British Columbia. It happened at Tumbler Ridge Secondary School yesterday afternoon. Police believe the suspected shooter died from a self-inflicted injury. The incident appears to rank as one of the deadliest mass shootings in Canadian history. And the U.S. House of Representatives could vote as soon as Wednesday on whether to reject some of President Donald Trump's tariff policies. The votes come after lawmakers last night rejected a last-ditch effort from House Speaker Mike Johnson to prevent them. And the Israeli Prime Minister Benjamin Netanyahu is set to meet U.S. President Donald Trump later today. And Netanyahu says he will discuss Iran, Gaza, and other regional issues with the U.S. president during his visit to Washington. The U.S. and Iran have so far struck a positive tone about the start of diplomatic talks. Let's get out to Tel Aviv now and speak to our Israel bureau chief, Ethan Bronner. Ethan, the Israeli Prime Minister is no stranger to the White House. He's paid almost half a dozen visits to the U.S. Since Trump came into office for the second term. What is he looking to achieve out of this trip? Because it was quite hastily arranged.
Quite right. It's actually, I think, the 7th, but you're basically right. Look, I think he's quite worried that the American-Iranian talks are going to limit themselves to stopping the growth of nuclear weapon development. And the Israelis are quite concerned about the Iranian ballistic missile development, as well as their ongoing support of their militias that in the region, so-called proxy militias like the Houthis and Hezbollah and Hamas. And so he wants to try to get the Americans to agree that all three are on the table with these talks with Iran.
Yeah, I will see. Obviously, both sides are presenting the first phase of discussions as constructive, but unclear exactly the scope of how broad those negotiations are. Ethan, how much is Gaza also going to feature in the discussion? Looking ahead to next week, we know that there is a plan for the first meeting of the so-called Board of Peace to discuss funding. Is that likely to come up in conversations as well?
There's no doubt it'll come up. This is a big issue because, from the Israeli perspective, it feels that the Americans may be sort of slipping away from a particular commitment to make sure that Hamas is fully disarmed before anything moves forward in terms of rebuilding. So that's going to be a big issue, too. You don't forget that Prime Minister Netanyahu is running again for re-election in the next 6 months, and he has promised his population that there will not be a threat from Hamas, from Gaza, and I think he wants to make sure that that happens. So, yes, it will certainly come up.
Okay, Israel Bureau Chief Ethan Bronner with a look ahead to that meeting that's taking place between the Israeli Prime Minister and President Trump later today. It's scheduled for around 11 a.m. Eastern Time, so we'll see what comes out of it. Well, tensions over Iran have pushed oil higher despite a U.S. industry report indicating rising stockpiles. Let's get more on the outlook with Francisco Blanch, head of global commodities and derivatives research at Bank of America. There is so much to discuss with you today, Francisco. I am going to start with oil because you were just talking about the upcoming meeting and obviously the geopolitics of the Middle East region. Oil, Brent, is getting closer to $70 here. How much of that can be attributed to pure geopolitical premium?
Well, yeah, thanks for having me. Look, I think oil right now and just the rest of the commodity complex is really dominated by three themes: geopolitics, trade, and technology. And certainly right now, geopolitics are the main driving force, pushing oil close to the high end of this year's range. But we still expect, of course, if we have kind of either a peace deal with Iran or maybe just kind of a limited skirmish like we had back in June, for prices to revert back to around $60 a barrel on Brent. The market is oversupplied. Inventories are rising. They've been going up for a while. And we expect roughly a 2 million barrel a day surplus this year in the global Brent market. So wow. That's the fundamentals. That's what the fundamentals are saying. There's a lot of barrels, and Saudi Arabia's post the return of OPEC plus barrels, or the group has. So we think those barrels will start coming back if we breach the $70 mark. And again, OPEC has a couple more weeks to decide what to do here. But there's plenty of oil in the market, and the price war or the recovery of market share that OPEC started a couple of years ago hasn't quite been fully finished, and there's more barrels to come. Yeah.
Okay, so you anticipated some of my questions. I was going to ask how much of an oversupply you see. You say 2 million barrels per day, but let me just ask you about OPEC as well. Do you think if we shoot above $70 and we stay there, that OPEC would then be incentivized to bring on some of the spare capacity they're sitting on back to the market? And if so, how much are you anticipating?
I think so. I think OPEC will bring back a lot of capacity. We're going to see a meaningful decline in spare productive capacity over the course of the next year or two. And again, if prices were to move meaningfully below $70 a barrel, we could have a resurgence in shale output in the U.S., which is probably the last thing OPEC wants to see. Remember, between 2022 and 2024, when prices averaged $86, $87 a barrel on Brent, we ended up with an extra 3 million barrels a day of U.S. crude oil output plus natural gas liquids. So OPEC doesn't want to have a repeat of that. Saudi Arabia itself ended up cutting 2 million barrels a day during that window. That's not going to bring back good memories. They need more volumes out there. So I do think the group will try to push more oil and recover market share, and certainly hope that over the course of the next 2-3 years there will be less spare capacity in the market.
Yeah. Well, let's pivot to some of the price action in metals. I'm going to start with industrial metals. Nickel this morning on our radar. We're seeing quite a big move upwards on the closure or the restriction of supply that's coming through from the world's largest nickel producer in Indonesia. And I guess this really speaks to the fact that this is a market that is really hinging on supply shortages, at the same time combined with a huge interest because of the energy transition and the scramble to get hold of raw materials there. Do you expect that to continue acting as a tailwind for nickel and other industrial metals?
We think so. As I mentioned, trade, technology, geopolitics, all at the center of the action here for commodities. There is nickel, there is tin, which has also been extremely tight. There has been a big run-up on copper, a big run-up on aluminum prices, and of course there's the precious metals, which are kind of acting with a life of their own. But yes, there is a strong push. The U.S. is trying to build under Project Volt a strategic reserve of critical minerals. That's $12 billion being put in place by the U.S. government. The issue with metals really is that we've moved from the 1990s Japan model of just-in-time to the 2020s Chinese model of just-in-case, and every government wants to take advantage of that just-in-case trend. Obviously, Indonesia, being the world's largest producer of nickel, is trying to bring the metal in line with what we're seeing across the industrial and precious metals complex. So I don't think there's anything other than that. They have a dominant position in the metal, and they're just trying to push the price higher by reducing quotas on what's effectively the largest mine from 42 down to 12 million tons. So doing so, they will support prices, and that's essentially the move by the government here.
Okay, so let's talk about precious metals, saving the best until last. It's been quite volatile a couple of weeks. Gold seems to be stabilizing around $5,000 here. I mean, how much of this move upwards in silver and gold can be attributed to speculative buying versus actual fundamentals and structural shifts? And, people talking about debasement trade, reserve allocation away from the USD into gold. So how much of the price action here is justified?
Well, look, I mean, precious metals are always speculative instruments, right? I mean, there's the majority of the gold comes straight from the ground and back into the ground. Last year, 80% of mine production went from 4 kilometers underground to basically 20 meters underground. So that's all speculative. And silver obviously has stronger fundamentals. There is no question. There's a use of silver in industry, in particular in solar panels, and you talked about energy transition earlier. But I do think, particularly the silver rally has been much more driven by retail buying. We saw tremendous turnaround in the SLV ETF, for instance, which is a preferred vehicle for investors. And also in gold, we've had a lot of investor money coming in. Central banks, however, significantly pulled back last year by about 20%. We saw a big decline in central bank demand, which I think is a concern to some. But of course, gold has become a bit of a hedge against just about anything. Fiscal worries in the U.S. and Europe, equity market concentration, and the investment in AI or monetary policy, which is why gold got washed out when Walsh was announced last Friday as a candidate, as a nominee to chair the Federal Reserve, allaying some of the fears that the Fed could become very political. So I think gold's a bit of a hedge against everything. We still like it. We still think it will go to $6,000 an ounce over the course of the next 12 months. But, of course, the volatility is eye-popping, and we don't expect the same kind of return, the same kind of Sharpe ratio, if you like, that we've seen, which I think may maybe reduce some of that demand for asset allocation.
Yeah.
So that's our view.
You know,
so
whatever you're worried about, I guess.
Yeah.
Yeah. So whatever you're worried about, essentially, buy gold. It's a hedge for everything. At least that's how investors are behaving. Francisco, really good to chat to you. Thank you so much for coming on. Francisco Blanch, Head of Global Commodities and Derivatives Research at Bank of America. Well, we're sticking to the oil theme today. TotalEnergies moving higher after slashing its buyback to $750 million in the first quarter of the year. That's after lower oil prices hit profits, fourth quarter net income dropping 13% year on year. For more, Mitchell Furman, our European oil majors reporter, joins us now. So let's start maybe with this lower share buyback. Is it simply down to lower oil prices, at least up until now? Because now, you know, we've seen the geopolitical premium being priced into the oil complex.
Yeah, for TotalEnergies, it is tied to the oil price. Late last year, Total guided the market that it would tie its share buyback to a Brent range of $60 to $70 per barrel. And so Total is kind of taking the position that the CEO this morning said that he doesn't know what will happen this year with oil prices. So this was a prudent move, he said, to shore up the balance sheet and protect it from any potential swings in price this year.
It's interesting to see the divergence in the way the market has taken the news out of TotalEnergies this morning. The stock is up versus BP yesterday. I guess BP speaks to perhaps a more broader structural move for the portfolio. But why has the reaction been a net positive for TotalEnergies on the news that they're cutting their buyback?
Yeah, Total told the market this was coming, right? So this was largely priced in. They gave a range, and this move was at the low end of that range. But investors were made aware that Total would be shrinking its buyback. BP investors, it's a larger story. BP's changing management. They've had years of underperformance, and the balance sheet needs significant repair in order to even embark on a growth story. So investors are also have no clue when BP will restore its buyback.
Yeah, I guess there's not a focus on cleaning up the balance sheet. How has debt featured in TotalEnergies today in their earnings report?
Yeah, debt fell for Total a little bit, and that's part of the story that Total is trying to tell, that this plan of cutting the buyback is to protect the balance sheet, in this year where a lot of folks are kind of projecting a oversupply in the market, but at the same time there is a geopolitical risk premium in oil prices. It's trading around $69 a barrel, and that's a much more comfortable position for the oil majors than at the low end of the range that Total gave last year of $60.
Yeah. Mitchell, really good to have you on. Thank you so much. Mitchell Furman, our European oil majors reporter. Well, Dassault Systemes is the biggest faller on the Stock 600 after giving a weaker than expected sales growth forecast on top of fourth quarter earnings that missed estimates. The French software company saw its biggest intraday fall since 2002. Dassault has described the AI boom as an opportunity for its industrial software business. And Siemens Energy shares rose to a record high, driven by strong order growth for its gas turbines. The German manufacturer says it's on track for another year of rising revenue. Speaking to Bloomberg, CEO Christian Bruch said that he remains confident in the company's AI-linked order backlog.
the AI is the cream on the cake for us on the orders, and you have seen it in the gas turbine orders. It's roughly 25% of the order book today is related to data centers. But keep in mind that actually the industry was actually much more designed to be a 60 to 70 gigawatt market not so long ago, right? And now we look into 100 gigawatt markets, and that is really a lot driven by the data centers. But important to note is that a lot of orders actually come not from the data center side. The largest order on the gas turbine side this quarter has been Europe non-data center. So it's a little bit more diverse, the picture, but I'm super proud of what the team has achieved to really build a position from ourselves in the data center market.
Yeah, and look, we're admittedly slightly obsessed with the data center story, given all the ruptures we're seeing in the markets. Christian, what are the risks that order backlog, as substantial as it is not converted into sales? What kind of risk are you putting on that as some out there question the spend and capex around data centers?
Yeah, first of all, I have to say, so far we see reservations converting more or less one-to-one into effective orders, and I have not seen any cancellations yet. And I would always say, as much as I understand the question around is there a bubble, is there a risk in there, electricity will be needed. Might there be, let's say, ripples along the road in terms of companies are changing? Might be, right? But for us, delivering the underlying electricity to these data centers, I'm relatively comfortable looking forward that this power will be needed. The other question you always also have to ask ourselves, what if we cannot supply the electricity to the data centers? Because AI is going to be around us at whatever level, we're going to need it. So I think it's really important that we fuel that industry to grow and prosper. And in that regard, I feel comfortable if I look on our backlog on the AI side.
Christian Bruch, CEO of Siemens Energy, speaking to us earlier. Well, coming up, sell first, ask questions later. Wall Street's rising fear about AI is pummeling shares from software makers to wealth managers. We'll tell you more next. This is Bloomberg. Heineken says it will cut about 7% of its global workforce, up to 6,000 jobs, to counter a slump in demand for alcohol. The Dutch brewers said total volumes fell 1.2% last year. The chief executive told Bloomberg he's seeing big differences between emerging and developed markets.
It's really a tale of two stories. We see our growth algorithm in emerging markets very much alive, where demographics, urbanization, GDP per capita is driving an increase in consumption. We have key markets like Vietnam, India, Ethiopia, South Africa, Latin America markets, which tap into that trend. The other tale, of course, is the more developed markets like Europe and North America, which seem more challenged and where bigger and bolder innovation is needed. Case in point being our Heineken 0.0, which locked in the 7th year of mid to high single-digit growth in the important US market.
Okay, good morning to you, Dolph. So if that's the story, emerging markets versus developed markets, is the alcohol moderation story in developed markets, is that going to result in you being more EM and alcohol-free focused as a business?
I think in a way these growth drivers have been there for a while. If you look to the focus of our M&A for the last 5-6 years, we did a big deal in India, which arguably is the biggest remaining opportunity for very fast growth. A big deal in Southern Africa with Distel and Namibian breweries. Very recently, very happy to close at the end of January our acquisition of FIFCO in Central America. So we are deploying our additional capital in growth markets with good fundamentals. And in the more developed markets, it is really about premiumization, which remains very relevant, and we are a global leader. Low and no is still, on a global scale, a couple percent. In the important European markets, already 5%. And key specific markets like Germany, the Netherlands, Spain, it's already 10%. So we believe this low and no and 0.0 beer has still really years and years of growth ahead of it. Dolph
van der Brink, the CEO of Heineken there. Well, investors have been aggressively selling shares of traditional wealth managers and insurers over fears that new AI tools will quickly replace their core services. St. James's Palace in London is one of the biggest fallers, down around 10%. Now, it follows steep falls in the U.S. yesterday, with Schwab, Raymond James, and LPL Financial all falling after startup Altruist unveiled a tax strategy tool called Hazel. For more, we're joined by Matt Bloxham from Bloomberg Intelligence. This seems to be becoming a bit of a theme. Sell first, ask questions later, and now it's hitting the wealth management industry.
Yeah, I guess we're seeing a mirror of the kind of buy first, ask questions later trade that people put on when the AI theme was on a tear. And, it's not surprising. I think a lot of the kind of marginal money that came into these kind of AI-themed stocks was really done on perhaps not a huge amount of fundamental analysis, just kind of buying everything, hoping that the kind of rising tide favors all ships. But, I think what we're seeing here is a wake-up call for companies across any kind of service sector, is that you're behind the curve on AI and that you need to give the market a much clearer steer on what your AI strategy is. I think, in the mid to long term, you would like to think that companies like this, St. James's Wealth, all these wealth management companies can actually successfully integrate AI tools into their offerings to maintain their kind of market positions. But I think a lot of companies have been slow to do that. And without that clarity, investors are kind of rightly asking the question, if you don't do something and do it quick, then maybe your business is in a lot bigger trouble than we thought.
Yeah, and sticking to the industry, huge capex spending plans. Alphabet raised billions of dollars yesterday, $20 billion in the U.S., $30 billion in total, a little bit more, to fund its AI capabilities. But the bond issuance was very well received by the market.
Yeah, it was, and I think that's an endorsement of Google's strategy and their position. Obviously, being a long-time leader in the tech market, there were, not so long ago, some kind of doubts about Google's exposure to the AI theme and the threat that ChatGPT posed to their big ads business, which is where they make most of their money. But Google's done an incredibly good job of integrating Gemini into existing tools, protecting its ad spend, growing the cloud business. So I think it's a ringing endorsement of the Google strategy that credit investors are prepared to back them so much.
Yeah, massively oversubscribed on those books, especially that 100-year sterling bond. That caught my attention as well. That was 10 times oversubscribed. So there you go. Matt Bloxham from Bloomberg Intelligence, thank you so much. Well, the big focus for investors today is going to be that jobs report. Let's take a look at how U.S. futures are shaping up as we head into the event. A little bit of green. Futures up 0.1%. The Dow up about 0.2. NASDAQ basically trading flattish. But it is going to be a market-moving event and a data point to watch out for. And, of course, it is delayed because of the shutdown. So that is happening later today. And then on Friday, we get CPI in the U.S. as well. But up next, Bloomberg Brief. This was The Pulse, and this is Bloomberg.